Now let's look at savings and wealth. The definition of wealth is as follows. So wealth is the total value of assets minus the total value of liabilities. So from an individual's perspective, the household's wealth is the household's assets minus the household's liability. If it is from the national's perspective, which we know that from the macro's perspective, the nation is composed of individuals, firms, and government. Therefore, when we want to come up with the wealth of a nation, then we add up the wealth of the household, the wealth of the firms, and the wealth of the government. So that's how we come up with the national wealth. So then now we want to move on to look at the savings. So the definition of the saving is the current income minus the current spending. So be aware that the concept of saving is different from the saving account we are talking about in our daily life. This saving is about how much you save at each time. So now I want you to think about and compare savings versus wealth. I want you to think about whether savings is a flow concept or a stock concept. Given that we define the saving is about the how much we save at each point in time, therefore the saving is a flow concept. On the other hand, for the wealth, which is something we talked about earlier, we say it is a stock concept. That is because it is the total value of the asset that we owned minus the total value of the liability that we have. Therefore, wealth is a stock concept. Saving is a flow concept. But this saving is not the saving we talk about in our daily life. It is not the total amount of the money that you have been accumulated in your saving account. It is not that definition. That the definition of saving in here is about the current income minus the current spending. It is about the what we get minus what we paid at each point in time. Therefore, it is a flow concept. And when we talk about savings, we care also about the saving rate, which is the percentage of the current income that we save. So we define the saving rate equal to saving divided by current income. So then we define what is the private saving. We say the private saving is the household saving plus the firm saving. So in here, the private means non-government. Given that the household is the owner of the firm, therefore all the firm's income will goes to the household. So then in here, when we want to look at the household's current income, which is the private disposable income. And then what will be the spending of the private sector? It turned out that the spending of the private sector is the consumption. So we minus consumption in here. Then we know that the private disposable income equals the GNP minus the tax plus the transfer plus the interest, which is our definition for the private disposable income. And then again in here, we minus the consumption. So for sure, after looking at the private savings, we know the government is also an important player in the economy. Therefore, we also need to look at the government savings. So as we know that the saving is related to the current income minus the current spending, therefore, we define the government spending as the net government income minus the government expenditure. That is the current income minus the current spending. Given that the net government income is defined as the tax minus the transfer minus the interest, and then again we minus the government expenditure, so then we know that it in fact equals to how much the government receives minus how much the government pays. And then in the term for the government, we say the difference of these two terms is called the government budget surplus. So similar to the discussion we have related to wealth, we talk about the national wealth. In here, we also want to talk about the national savings. So then what will be the amount of the national savings? For sure, we need to add up the saving of all the agents in the economy. That includes the private sector and the government. So then we define the national savings equal to the private savings plus the government savings. And then from the above equation, we know the private saving equal the GNP minus tax plus transfer plus interest minus the consumption, and the government's savings equal the tax minus transfer minus interest minus the government expenditure. Therefore, we add everything up. And then given that there are some terms that we can cross out, in here we cross out tax, we cross out transfer, and we cancel out the interest. And then at the end, we have the national savings, in fact, equals the GNP minus the consumption minus the government expenditure. So then in here, we can clearly see that the national savings definition is consistent with our definition for savings, which is the current income minus the current spending. The current income in here is the total market value produced by the domestically owned factor of production, which is GNP, and the current spending is the private consumption and the government spending, which is the government expenditure in here. And then we also know that the GNP in fact equals the GDP plus the net factor payments from abroad, and then we have it minus the consumption and the government expenditure. So we know the national savings equal the GDP, which is how much the country is produced within the country border, minus the payment to abroad plus the payment from abroad, that is the net factor payment from abroad, and then minus the current spending, which is the consumption, which is the spending by the private sector, and the government expenditure, which is the spending of the government sector. After looking at the savings and wealth, we want to move on to ask the question, what are the use of private savings? It turned out that we find the private saving has three uses. The first use of the private saving is for financing new investment, which is very straightforward. If we have only household in the economy, we know that when we save, we are going to invest. The second use of the private saving is to finance the government budget deficit. And later on, I'm going to show you why that is the case. And then the third use of the private saving is for acquiring assets from abroad. And again, I will explain that in detail later. So then to begin with, I want you to focus on the national saving. We say that it equals the GDP plus the net factor payment from abroad minus the consumption and minus the government expenditure. And then we also know that the national savings in fact equal the private saving plus the government savings. Then on the right hand side, we know that the GDP is in fact equal to consumption plus the investment plus the government expenditure plus export minus the import. And then we can copy down the remaining part, which is the net factor payment from abroad minus consumption minus the government expenditure. So now we know we can cross out some terms which include the consumption and the government expenditure. And then what's left in this equation is investment plus the net export, which is export minus the import plus the net factor payment from abroad. In here, we define the net export plus the net factor payment from abroad as the current account balance. And then so we can rearrange this equation. We say that the private sector's savings in fact equals the investment plus the current account balance, and then we move the government savings from the left-hand side of the equation to the right-hand side of the equation, and then we are going to get plus negative savings of the government. Therefore, based on this equation, we know the private sector saving includes to finance the new investments, and then it also can acquire the foreign assets, which is something I will discuss later. But right now, you just think about the positive current account means acquiring foreign assets. And then the use of the private saving will be for financing the government budget deficit. In here, the saving of the government is the government budget surplus. And then when we move it from the left-hand side of the equation to the right-hand side of the equation, it becomes the negative of the government savings. Therefore, when we give a negative sign, it changes from the government budget surplus to the government budget deficit. So then in here, we put the negative government saving on the right-hand side of the equation. And then if the government has the budget deficit, then it means that the government saving will become negative. And then the negative of a negative number will become a positive number. So then this whole term, that the negative government savings, will then becomes positive. And then it will be an additional term that adding to the private saving. So then we can claim that the use of the private saving include to finance the new investment, acquiring foreign asset, and to finance the government budget deficit. So now I want to explain why when we say the current account balance is positive, it implies that we are acquiring foreign assets. So remember that when we say what is the current account balance, we define it as the net export plus the net factor payment from abroad. So when the net export is positive, it means that we sell more goods than we import goods from abroad. And when there is a positive net factor payment from abroad, it means that we provide more factor of production that produce outside of the country border, and we have less payment that we pay to the factor of production that is owned by foreigner and work domestically. So then we define the current account balance as the payment received from abroad for goods and services minus the payment made to abroad for goods and services. Because when we sell goods or when we provide our factor of production to produce goods outside of the country border, we in fact will receive payments from abroad for goods and services that we provided. And in here, we're looking at the net, so we also need to minus the payment we made to abroad for goods and services that we have. So then, why when the current account balance is positive, then it means that we acquire foreign assets from abroad. That is because when it is positive, it somehow means that we receive payments from abroad. When we ship goods that we produce, for example, we produce this computer and we ship it to the US, then we are going to receive payments. When we receive payments, we argue that that means that we will acquire assets from abroad. So why that is the case? Well, that is because when you sell your goods, for example, to the US, the people in the US need to pay you something in return. They can pay you the US dollar bill. They can say, well, I don't have the currencies, but I have a house in Manhattan. Do you want that? That person give you a house in Manhattan in exchange for the computer that you produce. Then when you sell goods or when you export, it somehow implies that you are acquiring assets from the US. So given that we are talking about Taiwan versus US, so then that means acquiring assets from abroad. We then keep on arguing that this means that we are lending to abroad. So why that is the case? Well, you can imagine that if you sell your computer to the US, then the person buys the computer, says that, well, I don't have cash in US dollar and I don't have a house, but I have the US government bonds. Can I give you the US government bonds in exchange for the computer? You say, well, yes, I can accept the government bond as a payment to the merchandise I sell it to you. Then you will then get the US government bonds. If you get the US government bonds, then it means that you then become the lender to the US government. Then we can argue that when the current account balance is positive, then it means that we receive payment. When we receive payment, it can be equivalent to acquiring an asset from abroad. If that person don't give you cash, then they can give you a house in exchange for the goods that you produce. If that person don't have a house but that person owns a bond, then you becomes the owner of the bonds. When you sell the goods to that person, then it's as if you are lending to abroad. So then, of course, if it is the case that the current account balance is negative, it implies that the net export plus the net factor payment from abroad is negative. So then it is just the opposite of the previous case. So then it implies that we are borrowing from abroad. So that is why when we say that what is the use of the private sector savings, it is the summing up of the new investment, which is the I, acquiring foreign asset, which is the current account balance, which is a positive number, and the positive government saving with a negative sign, then which means the government budget deficit. So then the use of the private saving can be for financing new investment, acquiring foreign assets, or lending to abroad, plus lending to the government.